Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Chad here, your hosts for this weekend show. Also your host down at our website and through podcasts. Just search the KE Report in your podcast player, and on YouTube. Again, just search the KE Report. It's where you can listen to the full weekend show, as well as all our daily editorials and company updates. A lot of a focus being on precious metals as gold and silver continue to scream higher, and the stocks almost across the board are all doing very well. So this weekend show going to be focused on some of the technicals around precious metals, and then in the back half, some of maybe the more fundamental reasons as to what's driving these price spikes. We're kicking off the show with Richard Postma, a.k.a. Doc. It's been a while since we last had Doc on the show. And Doc, boy, oh boy, there's a lot for us to talk about, because the last time we had John was actually back in April, and prices have just taken off since that time. We've noticed some of your comments on our blog about how you think this could really keep going for the precious metals. Yeah, there could be a consolidation here or there, but you still think this is early innings. So, Doc, I want you to outline your thoughts, please.
Absolutely. You know that in the past, whenever we had hysteria over the gold market, it was negative when it topped out, and then it topped out and we'd get taken out again. But this one, I've been consistently bullish. This is a whole different ball game we're in. And I think we're probably in the second, third inning of this thing, if that. And there are so many technical factors that you can look at to tell you that, and not necessarily on the gold chart, because it's all rarefied air up here in blue sky, and we don't know how high it potentially could run. But especially with the silver market, which I think silver right now is just beginning to break out, and we're at prices we haven't seen for decades, if not centuries.
Well, Doc, that's for sure, because we're at prices in silver that we've never been at before. So I know people like to use the inflation adjusted and say it could be up to 200, but silver above $50 is something that's never happened before in nominal terms. And we're, as we record this, in the 53s. It's been above 50 for the last week. What do you make of something like that, where it breaks out of a 45-year channel? Some people say a cup and handle pattern. What do you make of an asset like silver that finally breaks up to new highs? How do you measure it? How do you look for resistance levels?
Well, you can look at the inflation-adjusted data if you want, but what's interesting is I went back to January of 1980 when it hit a monthly high of about 49.45, and then I went back to April of 2011, and the close was about, on a monthly basis, 48.70. So we've really taken out closing highs for silver, and just the fact that silver is in a deficit, and there are no really significant permitted mines coming on board anytime soon again. So we're going to be in this deficit going forward, and the demand will just increase. So those people that are talking $200 per ounce silver, they're not the crazy people anymore. That's a potential, and I'm quite sure we're going to see $100, and then it's anybody's guess after that how high it goes. But plus, the currencies are finally all being debased, and people are going back to tangibles and the metals and everything. So we're going to be in markets that when we look back someday, we're going to just be, I think, staggered by what's going to happen in these markets.
Doc, let's look at the gold chart. And I know how you like to look at a monthly chart, a longer term chart. We've never seen on the RSI gold this overbought. The MACD is at levels, again, that we haven't seen even after that 2011 peak that gold was kind of a historical rally up until that point. And the move has just escalated from last year when it broke out in March, and after summer boy, oh boy, we came back from kind of a slow summer period, and gold is tacking on double-digit percentage every month. And what we're seeing is $100 days up almost consistently here. What technicals can you look at, and what has you saying that it's still early innings here after gold has gone up thousands of dollars in a couple of years?
Well, Corey, and that's a tough one. You get up into the areas where you're so overbought, and it makes you a little squeamish, and you think, boy, maybe I should take some profits here. And it's hard to delineate how long it could stay up here. But when you look at the ADX, which, is a strength indicator, the black line is reaching a peak, but the green line is still heading up toward the black line, which is bullish. And then you could consolidate for a while. You could have some, even with the RSI, which are momentum indicators, you could start to turn sideways to south a little bit. But it would not surprise me if it does that we consolidate at these higher levels and then we move up again. So there are no good technicals right now to tell you how high this thing could go.
Yeah, when a market gets to that point where it's in uncharted waters, it's anybody's guess. But let me ask you this, as far as where we're at in the cycle, we've seen a textbook precious metals market unfold, Doc. We've seen it where gold ran first, then the best of the best gold producers ran, the big boys that had good cost did the best. Then you saw it trickle down into the mid-tiers and some of the smaller royalty companies. And then you start seeing silver move. You start seeing the silver stocks moving. You start seeing the juniors, gold and silver stocks moving. Those usually happen mid-cycle or later in the cycle. So does the move in silver and the move in the juniors signal that we're further along in this thing? Or what makes you think we're still early when we're seeing those later stage developments?
Well, because we have a lot of the producers that haven't even seen their highs in the past. And that tells me, that we have a lot further to run in just the producers, the good quality companies, let alone the juniors. So, take, for instance, a silver corp metals. We haven't even seen the highs back in 2020. And we're going to get up there. We're going to get up there pretty soon. But then I think we take that out and we even go higher. So even with the producers, we still have a long ways to go with those. So, and with some of the mid tiers now we're seeing it. But as far as the juniors, I don't think the juniors have got their momentum going yet. And that's to come in the future. So that tells you how far we have yet to go in this market. And, when we haven't seen some of these producers even meet their highs before, that should tell you something, that the gold price has even further to run because they haven't seen those highs, and this is the best cash flow they've ever seen.
So, Doug, it's crazy to think that some of these producers are not at all-time highs, but it's also crazy to see some of the moves that we've seen in the producers and even in the juniors. So some of these stocks, a lot of them are 10x where they were a couple of years ago. So would you be continuing to focus on the producers, the ones that are taking advantage through cash flows of these higher metals prices right now? Or are you going down into the juniors and into exploration plays because those typically can provide better leverage?
Yeah, I've spread my portfolio around between the producers, the mid-tiers, and juniors. And I'm pretty much at the point where I'm not going to be adding much more to them because they're at prices I don't want to add to, but I know they're going to run a lot farther. So I've been just enjoying this ride. It's been phenomenal to watch, and I've done really well in some of these stocks, and I'm happy for it. And so I won't be adding much anymore because they have a long ways to run, and I don't want to add to prices that are already high for some of them. I will look to some of the lower tier stocks that haven't run as much yet, and I might add to those because the price appreciation isn't there yet, and you still can get them at some pretty good prices.
Well, Doc, you want to throw out any more individual names? You've already mentioned Silver Corp, but as far as gold or silver, let's maybe just do the producers first. Any names you want to highlight?
Well, in the past, I've talked about Equinox. And Equinox, I think, is sitting pretty, and we talked this off mic when they got Caliber for the price they did, and they merged with Caliber. But now they have Valentine, the Greenstone projects, starting to gear up. And I think when they gear up, and if they can mine those at an all-in sustaining cost, and it's supposed to drop their all-in sustaining cost, if they're able to mine those, efficiently, they're 100,000 ounce producer a year. And so, that company I love, and I think it has so much further to run. And based on its value to their peers, it's low. Their value is still low. So when they start spitting out the cash flow where they can pay down their debt, I think that stock's going to run really hard.
Doc, let's look at this Equinox chart. And just for clarification, the company is trending towards being a 1,000,000 ounce a year producer.
Yeah, I'm sorry. I said 100,000. I meant 1,000,000.
There you go. Just wanted to correct you there, Doc. But looking at this chart, look, Equinox back after the merger was completed dropped down to a little under $8 on the Toronto market. Now it's up to $18. How high could this go? Because you just made the comment that you're not buying some of these stocks at these levels, but you still think they could go higher. So is it too late for somebody who doesn't have a position to get a position in Equinox?
No, when I look at the New York or the Amex, exchange that Equinox is on, and it's right now at about 12.75, I think that stock could move anywhere from $50 to $100 a share.
Holy cow. Well, so there's still room for the upside. Why not buy more then?
You could, but I don't want to put all my eggs in one basket on some of these stocks. So I've been buying some other things that conventional markets are a little undervalued. Plus, I'm trying to purchase some stocks that have gotten hit hard, who I know have good management and pay out decent dividends when they start to recover. So, because I've been in preferred bonds when the banks got hit, and I was in banks that had preferred bonds that were selling at a discount, but were paying out 8 to 9%. And they're going to come down. In fact, some of them are calling me out on those bonds. So I've got to find something else that I'm not working anymore. So I need a consistent, income, because I can't live off of the earnings I'm making now since I'm no longer working. So I like to have stocks that pay me dividends where I can live off of while enjoying the appreciation of these silver and gold stocks.
What about any other gold stocks? It does sound like you're bringing up a lot of producers here. Anything further down the food chain, or quite frankly, there anything that you're buying that hasn't moved?
Well, let me mention a couple other I love. Number one is, we talked about it, and I bought a ton of it when everybody were upset with the company a while back, but it took on new management, and I started to buy this at a very low level, and that was America's Gold and Silver Corp. And I did it for a number of reasons. Number one, new management, and that had a track record of turning around companies in the past. That was number one. But number two, what I really liked about it was their antimony play. And they're one of the only potential producers in North America. And this whole issue about rare earths, and I knew that the government might do something in that area from a policy standpoint, and they have. And America's Gold and Silver has just taken off, and that's already about a 4 or 5 bagger for me. And that's one. Number two, another company and I mentioned this company in the past too, and I really like, is Integra, and which is well managed, and they got a cash flow, and they're coming out with a bigger mine in the future. So that's another one I really like. But there's not a lot of other ones that that are non-producers that haven't moved too. So it's getting a little bit difficult to find companies at a low price any longer that haven't moved. So, but those are some of the companies I still like.
Well, Doc, just to follow up on the two you just mentioned, on America's Gold and Silver, in addition to the antimony, they're going to get paid on copper and gold, and they've been getting penalized on all three of those metals. That starts next year. But they also have this initiative. I just met with the company in Beaver Creek to fix their shaft and hoist to make it way faster and pull way more ore out. And they're using a different mining method now. They're using long hole stoping, where they had a bunch of guys with jack legs in there doing it by hand. Now they're blasting out whole sections all at once. So it's going to be more efficient. They think they can go from 2 million ounces a year silver equivalent to 5 million silver equivalent at their Galena complex in Idaho. So with a stock like that, with America's Gold and Silver, where they're going to be growing their silver and then getting all these credits from the other metals, do you just sit in it and ride it higher? Or is there any time where you would say, okay, they've achieved their mission down the road, I'm going to get out of it? Do you have any targets for how long you're going to hold it, or a price? How do you manage the hold period, and when do you exit?
Well, with these good companies, I don't exit until I think gold and silver has peaked. Because I think we're a long ways away from that. So I'm not going to exit from any of these good companies. I'm not selling any of these. I'm a long-term holder. I think we're going much higher with gold and silver, and I'm not going to get out of them until I feel that we finally have peaked out on gold and silver pricing. I might add that if one looks at one of the charts I'm going to watch over time to tell me if we're getting close to peaking is the industrial to gold ratio chart. And we're a long way. I think in the past, we've seen a gold to industrial to gold ratio of 1 to 2, 2 times in the past. And I think we're going to see that again. So when we get down to those kind of levels, it's just one of the charts I'll be watching amongst a couple. Then I'm going to get serious about thinking whether I take my profits.
Okay, Doc, let's dive in a little bit more to this because, look, everybody or most people are calling for some sort of a correction. It's definitely due. We just outlined how overbought just the metals prices are and a lot of these stocks are. But I think this bull market is reminding everybody what a bull market is that we can stay overbought for a while and just keep pushing higher. So balance out what a correction looks like in your eyes. And then, okay, you just gave us the Dow to gold ratio in terms of what that could drop to, but what does that look like on a gold chart? What does a top look like rather than a correction?
I think we could pull back 10% on a correction on this gold chart. I think that's possible. And I think then we can consolidate. We can for a while, but eventually we will break that consolidation and we'll move higher again. But I don't see a huge sell-off in this gold and silver move. I don't expect anything like 20, 25%. But I would expect a shallow correction for these, and then we could consolidate for a while, and then after that we would start to move higher again. I think that's what we potentially could see, because there's going to be a point where we're going to have to do some consolidation here.
Well, Doc, we'll keep watching for that consolidation and maybe have you back on at that time and see how you're playing it. Just want to open it up to you. Obviously, gold and silver are doing fantastic. Same thing with the equities. Are you getting animated to rotate anything like down the road? I know you said you're not selling anything right now, but would you be animated to rotate categories to get out of gold and silver and put it in, say, copper or uranium or lithium or nickel or oil or gas? Is there any other commodities you would consider rotating wins out of at one point, and which ones are they?
Absolutely. And there's only one area, because I think uranium already has had a good run. I think that's going to continue. But what I'm looking at right now, and I've started nibbling, I think oil and gas is an area that you want to be. And I think there's going to be a great opportunity, there has been already, to buy some of these good stocks at low prices. And so that's the one area in the commodity sector I'm trying to build a position in over time, because it's scraping the bottom. And so I'm focusing on oil and gas to be my next one, that has a run. But I don't think that's going to happen for a while. So I'm taking some positions at low prices, and some of them are coming back here. some of them had a little bit of run. They're going to come back, and I think they're going to double bottom. And so I'll add. So that's the one area I'm really looking at to add in.
Care to share any stocks or the type of stocks in the energy sector that you're buying? Is it the higher producers, the larger producers? Is it growth oriented? What or where are you adding?
I like Baytex Energy, stocks like that. And then I also like Cliff Energy. Those are two I'm following closely, and Birchcliff has come off, and I'm probably going to add a little bit to that. And then one of the other ones I'm looking at is Vital Energy. And then another one, those are three so far that I've got positions in a couple of them at low prices, and they moved up a little bit. Now they're coming back. And then there's Ultrapar out of Brazil. And I bought that at low prices, and that's had a little run, but it's going to come back here again. It's looking like technically it's coming back. And so those are four that I'm personally looking at right now. I might add what's interesting too about the fact that I think we have so much further to run in these stocks is, I don't know if you're aware, but the chief investment officer of Morgan Stanley just put out that they're recommending now that you have 60% in the market, and you have 20% in the bonds, and you have 20% in precious metals. And I mean, for a major investment house to say that, that's amazing. And then you have Jeffrey Gundlach, who is the bond king, and he's talking 25, 25, 25, 25 as percentages, 25 in stocks, 25%, 25% in bonds, 25% in cash, and 25% in precious metals. And so another interesting chart is a chart when you look at the central banks and their purchases of gold, and the fact that they're getting out of treasuries. There's a chart that shows the treasuries decreasing over time and the gold increasing, and gold is about to bisect the treasury that they hold. And so gold's going to go much higher with these central banks yet. So those are charts that normally we don't look at.
All right. Well, good points there, Doc. Hey, look, this is a bull market. A lot of opportunities, I guess, to still make money with some of those higher targets that you even have. It's great having you back on the show. That was my fault for not reaching out to you earlier, but hey, maybe it was good karma for the precious metals that just kept screaming higher, and this was another good week for precious metals. So, Doc, thanks for joining us on this weekend show, and everyone stick around. We're going to continue focusing on what's going on in the gold and silver and maybe even some other precious metals areas with Jeff Christian up next. So everyone stick around. We're going to be right back.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. I hope everybody enjoyed those first two segments. Getting Doc back on the show with some of his technical insights into the precious metals markets. Now we're bringing on Jeff Christian, managing partner at the CPM Group, to give us more of an inside track on what he thinks is happening and what's driving these, in all fairness, crazy rallies in the precious metals. And Jeff, I want to start with silver. It was about a week and a half ago, maybe a little bit more than that, that we had some backwardation in silver. So the spot market was priced a couple dollars higher than the futures market. That did correct itself after a few trading days, but it all happened right around the time silver was touching $50 an ounce and breaking out from there. And quite frankly, we have seen silver just continue to skyrocket from that $50 level. We are recording this on Thursday, just the same time as we recorded with Doc, and silver is, again, over $50 an ounce at almost $53.50 right now. Jeff, give us an inside track here. What are you seeing in terms of what's driving this silver rally and breakout over $50?
The primary driver right now is speculative buying. Short-term investors and others buying silver in a expectation of short-term higher prices. And the interesting thing to us is you're seeing this in gold and silver, which, if you look at past spikes like this, 1979, 1980, 2007, 2011, were times of economic strife. But you're also seeing it in aluminum and copper and platinum and palladium and stocks and bonds and even the US dollar. So what you're looking at a situation where financial markets seem to be saying, okay, we are in a relatively strong economy, but there are cracks appearing all over the place. There are rising political risks that have not only political and social implications, but also economic and financial implications. You have the US government shut down. It hasn't been shut down this long since the first Trump administration. He's going on record as having the two longest term government shutdowns in the government's history. But you've got in financial markets say, okay, things are okay now, but there are cracks appearing. And there's a tremendous amount of money. There's more money in circulation, and there's a larger portion of it and a larger volume of it in cash, treasuries and bank CDs than ever before. And these guys are sort of saying, where do we put this money? And it's going a little bit here, a little bit there. So you've got a lot of money chasing a very small market. The backwardation that we saw was in London. London has some tightness in its physical supply. That's being resolved. Over the last week, you have seen about 18 million ounces of silver come off of COMEX depositories, and a larger portion of that has been air freighted to London. And if you have a memory that goes back as far as 2021, you might recall that London, we saw, at that time, you saw tightness in the silver market in 2020, 2021 in the US market. And London had a large amount of silver, and you saw a big shift. The arbitrage allowed people to buy in London and send it to New York. And New York inventories went from 100 to 530 million ounces, while London went down to about 770. It's about 790 million ounces now. And yeah, a large portion of that is in ETFs, but you still have like 136, 150 million ounces in unallocated silver in London. So what you're seeing is that the ARB has reversed and silver is going back to London. That tells us that this trade is unwinding in the silver market. But the reality is that the silver price has risen not just because of that tightness, it's been rising in concert with all these other assets too. So clearly there's something else going on. If it was just tightness in the Indian and London silver markets, the silver price would rise and these other things wouldn't be rising. The fact that gold, platinum, palladium, copper, aluminum, stocks in general are rising tells you that there's something bigger going on that's probably more sustainable than the flip in the ARB with London.
Yeah, it's a great point, Jeff. We're seeing up moves really across the board in the metals and all over the commodity sector, with the exception of oil and gas, but then also in the general equities, in the cryptocurrencies. Just it seems to be a melt up everywhere. But just focusing on silver for one more question here, when you see a move like this, you mentioned that 2021 period where we had a nice jump. That was when you saw the birth of this silver squeeze idea. And we're getting a lot of questions coming in. Is this the silver squeeze? And this comes up every so often. And I think that anybody can realize that when a market turns, there could be shorts that are out of position and they have to cover. But the idea here being that the physical market and all these investment forces are going to squeeze the prices higher. A lot of people think that's why it didn't slow down at 50. What are your thoughts on this whole silver squeeze narrative?
I think the silver squeeze narrative is pretty much nonsensical. And you have to understand, the shorts on the COMEX are hedges of long physical positions, most of which is leased out to industrial companies. So if you're a bullion bank, you're not being squeezed because you're in your first motion, you're price neutral. Your silver price has gone just this week from $46 to $53. Your physical silver has increased in value. Your short position offsets that, but you're earning interest rates on that silver that you've leased out to industrial concerns. And those lease rates, have risen. They're not 200%, but they have risen. And B, they're being calculated on $53 silver instead of $46 silver. And 46 is not an accurate number because most of those leases use the end of the month lease rate and the end of the month price. And at the end of the month, silver was about $45 an ounce. So you're going from $45 to whatever the price is going to be on average this month. So the bullion banks, if they're being squeezed to record profit levels. So it's nonsensical to think that's what's going on. What's really going on in the silver market is the Indian market is very tight. The Indian market's very tight for a variety of reasons. One being that the price had actually declined over recent years to a point where it didn't make sense to import silver so much from abroad, and people were selling silver. The price was weaker in India because people were selling silver, and they have enormous amounts of silver that was being refined into good delivery silver and kept that price down to the point where now the silver market in India is tight. India has now started buying silver from London, but you also had a lot of London metal move over to New York, as I explained earlier. So the London market had some reduced amount of inventories. Now, one of the important things to remember is that if you're trading futures or forwards or options, you don't actually need physical metal. 99 point something percent of those forwards and futures get settled for cash. And they always have, not just in a squeeze or a force majeure. They always have. That's the nature of that market. So if you think that by pulling out silver in physical silver inventories from COMEX registered stocks or London registered stocks is going to push the price up, you don't understand the silver market at all. It's just like that's not an issue there. What's an issue is that you need a price differential great enough to move silver into India, and you need a price differential, which you've got now, where it's not only makes sense to take, again, we saw 400 million ounce increase in COMEX inventories over the last couple of years. Some of that already is going back, about 5% of it's already going back to London, and probably some more until you get into an equilibrium and that arbitrage closes up to the point where the markets are pretty much in balance again.
Jeff, I'm curious, your initial comment there that this is speculative buying, fair enough. That is what we see usually in these price spiking environments, but dive more into the COT reports. You gave us some insights there, but what are you seeing on those COT reports that is maybe out of the ordinary or something that we should follow as, I guess, we continue down this road of just higher prices?
I'll be honest with you, I really haven't even looked at the COT reports other than to see that, yes, you have seen some increase in investor purchases on the long side, but it's not out of the ordinary. And if I grab those price charts and look at them, I'm pretty sure what you're going to see is that the balance of silver COTs is not particularly out of typical range or recent range. Just looking at it, if you look at gross long positions that investors had back in 2016, 2017, they were 650 million ounces. Today, they're about 450 million ounces. So, and if you think about it, in 2016, 2017, the price of silver was something like $12 to $15 an ounce. So the futures market isn't necessarily reflecting blind bullishness. Now, those are a little bit out of date because, again, we don't necessarily look to the COT data as a major factor in determining our short-term to medium-term price projections.
Well, Jeff, I appreciate you diving into silver with us. Let's shift over to gold, the mothership here. Over $4,200 on the futures, really almost up to 4,300, and it did tag 4,300 earlier today as we record this. What is your take on the breathless move higher in the gold price?
Well, again, it's investment demand. Despite what you hear from marketing groups, central banks have actually pulled back pretty sharply on their gold purchases. They tend to be more price sensitive than individual and institutional investors. You've seen a lot of momentum traders pouring into the gold market, as with silver and platinum and palladium too, if we want to get into those later. But, it's a lot of short-term momentum traders, technically oriented traders. It's funny because I was listening to some of the commentaries online from the people who pushed the silver squeeze and the world's running out of silver 4 or 5 years ago. And on Monday, they had this guy talking about, look, the refineries have gotten so much silver. Well, first off, the dealers have had so much silver sold back to them. And these are medallions, 1 ounce medallions, 10-ounce bars, 100-ounce bars. These are investor-sized products that the dealers have been sending it to the refiners. The refiners are backed up, and they've stopped. Several major refiners have stopped buying scrap silver because they have this stuff that's 3/9 silver, needs to be upgraded to good delivery, melted down and cast into 1,000-ounce bars so that it can be delivered against COMEX or London position contracts. And so, or just used as collateral in the OTC bullion banking market. Bullion banks won't buy 100-ounce bars. They want 1,000-ounce good delivery bars. They don't even want 1,000-ounce non-good delivery bars. They want 1,000-ounce good delivery bars. So the refineries are backed up. The dealers are saying that most of the people coming into their stores are selling gold and silver as opposed to buying it, and they're not seeing a lot of buying stuff. Again, that speaks to my view that, just over the last 5 days or so, but really over the last couple months, you've seen a lot of indications that the short-term upward pressure is probably short-lived and could come off some. Longer term, we still expect higher prices for gold and silver because politicians around the world are giving us every reason to want to have more of our wealth in gold and silver as opposed to currencies. And that's going to continue. But you've got markets that really look overheated on a ultra short-term basis right now.
Oh, it's so crazy to see just as little anecdotal evidence as well in Vancouver, where I live, not far from my house. There's been 2 brand new shops that have opened up that are all about buying your gold, or I guess, and selling it back to you. But we haven't seen this since, 15 years ago, Jeff, when it was a very different market. Just curious, though, in terms of all the money that we are seeing come into this sector, whether it's just in gold or also all the financings we are seeing on a company front. This ties into what we've been seeing out of big institutions, U.S. institutions, banks upgrading their targets for gold, and that whole narrative of the 60-40 portfolio that has turned to the 60-20-20 portfolio where 20% should be in gold and these safe assets. What do you think about these calls from the big institutions getting behind the precious metals?
It's exactly what you saw. I lived through 2007, 2011, and the aftermath. And I lived through 78, 79, 80, and the aftermath. And in each of those instances, this is what you saw. And that's true in gold and silver, but it's also true in other assets. The head of Merrill Lynch, which went bankrupt because of its collateralized mortgage obligations positions, when he was asked about why they loaded up so much on CMOs, he said, look, we knew this was junk, But if we wanted to be in the brokerage business, we had to deal with this junk. And that's not to say that gold and silver are junk, but what it is to say is that banks and brokers will follow trends just as much as smaller investors and others. And what you're seeing right now is banks and brokers saying there's money to be made in precious metals, so let's get back into precious metals. And it's nothing more than that. And I always get worried when everyone's talking about gold and when the dumb money shows up in gold. And when you find banks and brokerage houses that a year ago were poo-pooing gold, all of a sudden predicting enormous prices. And in terms of, where they're predicting these prices, if you delve into what they use as a basis for these predictions, pretty much it's a chart. It's a price chart, because they don't really understand the fundamentals of supply and demand. And insofar as they even look at the supply and demand fundamentals, they look at the skewed data that comes from marketing groups that, will tell you that central banks are secretly buying 20 million ounces of gold in violation of international agreements they've made over the last 20 years. And the banks and brokers they're in the crowd running with the bulls just like everybody else, So, I don't base my view. I pay attention to the fact that all these people are now bullish on gold, because it's a sign that this market has got a lot of uninformed money pouring into it.
Yeah, unfortunately, we see that when any market takes off. We see that in the tech sector. We see that in biotech. We see that in just any sector that's running hot. You start just attracting people buying for the sake of buying. I guess that brings up another question that we keep getting sent. What is driving these metals higher? And we hear from certain pundits that it's geopolitics. I don't know how much of that is actually baked in, but we also hear that it's the threat of the dollar collapse and the fiat collapse. We hear that it's the BRICS nations buying it. Of course, the central bank narrative comes into it, but as we've talked about with you for a long time, Jeff, it's really at the investment side of things, at the fringe, that moves the price. Are there other factors that you're looking at? I mean, does the Fed rate cutting tie into this? Does geopolitics tie into this? How much of that is what's moving the price?
Yeah, international politics are a major factor right now. And in fact, one of the things, and not just in international, but also national politics are another major factor. And not just US national politics, but national politics around the world have become much more problematic, both socially and economically. So one of the things that we've talked about in the last year or so is that you've seen a shift, whereas in the most of the time, economic and financial market concerns are the major drivers of investment demand into gold. But in the last year or two, it's been international and national political factors that have been the major drivers of stimulating investors to buy more gold. That's not to say that economics and financial market stability and risks aren't in there. It's just to say that the political environment around the world is much more treacherous now than it has been for decades. And it's stimulating that investment demand. That's clearly in there. Then there are shorter term trends like, Fed interest rates. And we've said this for years when people kept begging the Fed to cut interest rates for years. And we kept saying, be careful what you wish for, because the Fed will only cut interest rates when it sees serious economic problems on the horizon. And that's what's happening. So now you've got, just in the last few days, as the prices of gold and silver have risen, you've seen on the FedWatch, CME FedWatch market, you've seen people increasing their expectations of more Fed interest rate cuts in 2026 and 2027 than they had been saying. And you're seeing Jerome Powell indicate that that's probably going to be the case. That tells you that the Fed, which has probably the biggest and perhaps the best economic research department in the world, The Fed looks at the world and says, we have problems and they're on our doorstep. So that factors in both on a shorter term basis, more interest rate cuts sooner, and on a longer term basis, longer term economic financial market instability and consequentially political and social issues too, fostering today. In terms of the BRICS are not buying gold. I mean, China is buying some gold. Russia's buying and selling gold to finance its war effort and its government. South Africa, Brazil have not been buying gold. They have very little gold. They need foreign exchange. So they don't really have a lot of foreign exchange to buy gold, and they don't necessarily, as central banks, see gold as something that they should be adding to their reserves. India has bought some gold in recent years too. But they're not buying a lot of gold and they're not necessarily dumping the dollar. You did see a lot of dollars and treasuries sold by the People's Bank of China over the last couple of years, not because they're dumping the treasury, but because they've been pouring money into their economy to keep it out of recession. And most of their monetary reserves are in US treasuries. So if you have 60 or more percent of your reserves in treasuries and you're using a quarter of your reserves to keep your economy out of a recession, which is why you have monetary reserves, by definition, a significant portion of what you're selling to finance supporting the economy is going to be US treasuries. It's not that they're pissing on the treasury or the dollar. It's that they're using their monetary reserves to keep their economy afloat. And I should say, if you look at the September data, Chinese imports into the US are off like 27% in September from the month earlier. They were off 27% in September, but Chinese total exports worldwide rose 83%. Right? So, yeah, they've got an economy that's got some problems, but not as bad as ours. So that's there. And then, it's like, are other people dumping the dollar? Well, the dollar did in fact fall about 10% from 130 on a Fed trade weighted basis at the start of this year to about 120. So, it's off whatever. And it's been moving sideways now since June or July. So that decline in the first half of the year seems to be past. And even at 120, it's up from 110 in 2021. In 2020, 2021 during the COVID and post-COVID era. So it's still, the dollar is not collapsing and people aren't dumping the dollars on an international basis. The number of treasuries, the volume and value of treasuries held offshore are at record levels. They've been rising about 10, 14% per annum the last couple of years. People aren't dumping the dollar despite what the gold bugs want you to believe, so you buy gold. It's just, that's not a factor there.
Jeff, this all does, to your point, seem like speculative buying and quite simply a momentum trade. Gold led the way last year when it started breaking out and just kept on hitting all-time highs. People started taking notice. We've now seen money move down into silver and some of the other precious metals like platinum and palladium. And as much as we hear of all the uses of platinum, palladium, and silver, its industrial uses, to me, this just, again, screams of speculative buying and a momentum trade. I know it feels weird for a lot of the precious metals bugs and bulls because we haven't had this sort of momentum in well over a decade. But the market, again, to what I think it is, it's not all these underlying uses. It is simply a momentum trade into precious metals with gold that has led the way. So am I off base here, especially tying in platinum and palladium and the moves we've seen in those precious metals?
I would say you're off base. If I could use a baseball metaphor, you're off base in a way like a base runner takes the lead off the base before the pitch. The vast majority of the reason why gold, silver, platinum, palladium prices are rising is speculative buying and momentum trading. And you see that because, like if you look at platinum and palladium, rhodium prices have risen a little bit, but not that much. Why haven't they risen as much as platinum and palladium? Because rhodium doesn't have a futures market. If you look at platinum and palladium, most of the buying that you're seeing is in the futures markets and the forward markets, not in physical metal. Okay. Industrial users buy physical metal because they need it. Investors buy futures and forwards. So you're really seeing that. Now, there are some positive signs in fabrication demand for silver and solar power, and in some segments of the auto sector for platinum and palladium. But if you look at the biggest use of silver and gold in jewelry and decorative items, that's off in China, it's off in India, the two largest markets, and it's probably off in the rest of the world as well, partly because of the higher price, partly because people have pulled back on buying discretionary products and luxury items in expectation of more hostile economic conditions. So there is some supply and demand fundamentals that are in there that you have to pay attention to, but the vast majority of the buying has been short-term, speculative, and long-term investor demand.
Sure seems that way. But hey, that drives prices quite drastically too. And that's, I think, why we've seen these price spikes, and silver just keeps on going. Same with some of these other precious metals and gold. Let's not forget about gold. That is also just on a tear, and all the stocks are doing well. So another weekend show where we focused on precious metals, rightfully so. There's a lot to cover on the positive side, and I hope that a lot of our listeners are making money in this market, because from what I'm seeing, a lot of these stocks are going up and the metals are going up. So, Jeff, thanks for taking time with us on this weekend show. And everybody, thanks for tuning in to this weekend show. Be sure to check out our website, kereport.com, and podcast and YouTube channel. Just search the KE Report in your podcast player to listen to all our daily editorials and so many company updates each and every week, trying to keep all of you as informed as we can. Everyone, I hope you have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.